Subscribe to our channel and also press the bell icon to get updated whenever a new video is uploaded.
Hi friends, so it's the tax saving season. We've got 1 month to go for the financial year to end, so a lot of people will be rushing to buy financial instruments through which they can save tax. It's actually a great idea, and you should actually be careful while doing this, and I'll sort of explain why you should be careful, especially when you're buying life insurance plans. Not all life insurance plans have tax saving benefits, and I'll explain the scenarios with an example. So we have section 80C of the Income Tax Act, which says that you can invest up to 1.5 lakhs. If you invest that in certain financial instruments, you can deduct that from your income while calculating your tax for that particular year. There are tools like NSC, PPF, FD, mutual funds, and life insurance under which you can get a rebate under this 1.5 lakhs head. The problem is that not all life insurance plans actually have this facility, and unless you're careful, chances are you will actually move into a lot of trouble. In fact, it can be quite painful. The money which you invest will not be tax-free, plus the maturity benefit which you get will be completely taxable. So be careful. Let me explain a scenario. So here's what the rule says specific to life insurance plan. The premium which you pay should not be more than 10% of the sum assured of the cover. If it is more, you don't get the benefit for the entire amount. You get it only for 10% of the sum assured. So let me explain this with an example. Suppose you rush in to buy a plan at the last moment, and since you want to invest a large amount, you go and invest 1.5 lakhs straight away, and you buy a plan in which the cover amount or the sum assured is only 7.5 lakhs. Now here, if you see, the premium which you pay is 1.5 lakhs, the sum assured is 7.5 lakhs. So it's only a 5-time multiplier. And it very often happens in single premium plans. Now, the amount of 1.5 cannot be used to actually get tax benefits because it is not 10 times. The sum assured is not 10 times of the premium which you're paying in this particular year. So you will get benefit only to the extent of 7.5 lakhs as the sum assured, 10% of that is 75,000. So though you've paid a premium of 1.5 lakhs, you get tax benefit only of 75,000. So that's something, it's a mistake which I have made in my very earlier years. And a lot of people write back today to me saying that, I have done this, I don't know what to do, I can't claim tax benefits, is there some way to, help me? But there is no way that can be sort of, help later because you made a mistake. And so don't rush into it, understand the complications, especially when you're doing it at the last moment. Basically ensure that the plan which you're buying, the premiums which you pay in a year, that should be less than or equal to 10% of the sum assured being offered in the plan. Now what's the worst part of it is, if this 10% criteria is not being met, then the entire maturity benefit now becomes taxable. So you take a hit now, and when this plan matures, it makes it worse because then the maturity amount also becomes taxable. So it's a bit of a double whammy, and hence, given that you have 1 month and a lot of people will be rushing to buy this plan, be careful about it, and especially with single premium plans. So that's scenario 1 which can go wrong, in which the premium paid in a year exceeds 10% of the sum assured of the plan. Now let's take scenario 2. You buy the plan, but you actually don't continue it for a long period of time or for a specific period of time. Even in that case, you lose the tax benefits which you've taken. So here are the scenarios. In case you bought a ULIP, you have to pay premiums for 5 years and keep it active so that you can claim all that 5 years of tax benefit. If you stop it in between, you cannot get benefits. Single premium plans, they also have to be held on for at least 2 years. So though you made a single premium, after 1 year, if you tend to withdraw it or surrender it, you will lose the tax benefits which you got in last year, and you'll have to pay it again this year. So hold it for 2 years. And the other traditional life insurance plans also have to be kept active at least for 2 years. So you have to pay the premiums for at least 2 years. And then if you want to surrender it in case of an emergency, you can, so that the tax benefits which you have availed are valid and you don't have to pay it in the subsequent years. So largely, these are the two factors which you need to keep in mind when you rush into buying a life insurance plan at the last moment for saving tax. I hope you find it useful. Thank you.